love the channel and find it useful in becoming a happy retiree. Subscribe today. Now, let me go back to a bigger, more important discussion at hand today, and that's this fascinating debate between Thomas Lee and Mike Wilson, two Wall Street heavyweights. I've already gone into their bios, are the MBAs from these great schools, and one's from Wharton and one's from Kellogg School, and they're at the top of their game, 25 plus years. One was the chief equity strategist at JP Morgan for many years, now running his own firm. The other still currently at Morgan Stanley. Bright guys, and they make really important points. But the debate here goes back to the same question that you and I have been wondering, and I wonder about every single day, and I want to give you an answer today in this 10 o'clock hour of where I come down on this issue. But the question is, here we are as markets have done so well, where do we go from here? Is this the very end of the cycle, late stage? We talk about economic cycle. Remember, you come out of a recession, you have an expansionary period of time that lasts for a particular number of years, depending on what the cycle looks like. The economy starts to heat up, gets a little frothy, and then it cycles back down as people lose jobs and creates a next recession and then the next recovery. And that's the cycle. When I say the economic cycle, that's this progression that I'm talking about. Where are we? Are we in the beginning, middle, or end of that? Because it matters for markets. The debate that we have uncovered, I'm going to play for you right now, goes to this very important discussion. The clip you're going to hear, it starts out with Thomas Lee, who talks about an equity market that he thinks actually has another 11 years of upside, where the other commentator, Mike Wilson, thinks we're close to the end of the cycle. Let's go ahead and play that clip.
It's important for investors to think long-term. And I think if you think long-term, the things that really end up being risk for stocks is misallocation of capital. Like, is the economy over-allocating to low-return projects? And I think what we've seen is, look, we've had so much caution since '09 that animal spirits have been depressed. Now we're starting to see the surveys, small businesses, ISMs improve, and there's a lot of pent-up demand. So I think it is tough to say where we are in the cycle. I think it's closer to mid-cycle. Like, if you look at housing starts, even auto sales, and investment to GDP ratios, and then you look at global sort of business cycle, it seems mid-cycle. So I think it's important to think long-term, and long-term, you're
suggesting that we're, say, in the fourth or fifth inning of a bull market?
Yes, I mean, I think it's interesting. So we do a lot of long-term work, both myself and Rob Slimer, but I think both of us think it's more like 2029 is the peak of this equity market cycle. And then, the S&P is, 6,000 to 15,000. So, I think it's just important to be long-term oriented right now.
So, well, look, I mean, I agree with that.
And here's where the disagreement comes in.
But from a cyclical bull case, I don't agree with that at all. And I think it's pretty clear to us that we're late cycle from an economic standpoint. So the two things I would point to is the unemployment rate. I mean, we're 4.1%. We're 50
Could have a three handle on it, according to some, soon.
Right. So what does that mean? There's not a lot of labor left. And that's really the key ingredient for calling an economic slowdown. When you run out of labor, costs go up, and then basically that's when companies fire people. And that's what causes an economic slowdown. That doesn't mean the secular bull market is over. But to kind of make the suggestion that we have 2 or 3 more years left in this cyclical sort of expansion, I think it's very misplaced.
Wow, very misplaced. See, these guys, that's like a real argument on live television. These guys almost got out. It was almost a full-blown brawl on the set. So here's the reasoning between these two. So again, this argument is one saying, look, we got 11 years to go. Thomas Lee saying we're going to 6,000 in the S&P or 15,000 in 11 years. That would equate to another 7.1% rate of return all the way to 16.5% per year from here on average. That's a big deal. But his reasoning is that the economic data is mid-cycle. And that's this whole analogy of fourth or fifth inning. And what does mid-cycle mean? Well, if you look at housing starts and you look at auto sales and other data points, wage growth is another one, at 2.5%, interest rates still way under normal levels, then, and if you look at some of these charts as I pulled, housing starts if you look from 2000 to 2007, stayed around the 1.75 million mark. Today, we're well south of, we're around 1.1, 1.2. So we got a long way to go for these major economic data points to get back to where they were before the recession. We have not fully recovered. Hence, mid-cycle, meaning, hey, there's a ways to go before we get back to where we were. There's also, he also brings up the point that bonds face headwinds and baby boomers may increase their allocation to U.S. equities or just stocks in general over the next several years, over the next decade. And that animal spirits, which I think is an important point, are still to some extent depressed. But we're starting to see some of that change. We're starting to see some small business owners and so the small business community have more optimism. And these surveys, so the soft data of, hey, how do we think we're going to fare over the next year, start to improve. And that long term, and that's the key to understanding this argument, the year 2029, that is his call for the peak in the stock market cycle. On the other side of the coin here, in what Wilson is saying, is that in the short run, and that's part of the disconnect between these two. One's really talking about the next the next decade. The other's talking about the next couple of years. He's saying, hey, it's pretty clear to us that we're in the late economic cycle because we already have the unemployment rate so low. There's not a lot of people left to go get jobs. So when that happens, we get towards the end of the cycle. And that's why he's saying, I think it's misplaced that we're going to continue to run here. This is the window that creates so much confusion. And here it is. Number one, you've got this, and here's why it's confusing. Number one, we've got long-term versus short-term versus economy, economic cycle, cyclical, secular. Hey, what do you pay attention to? All that jargon gets confusing. What does it mean for your investments? What stage are we in? Is my outlook, what is your outlook? Do you have a long horizon, a short horizon, somewhere in between? So we're gonna decode this debate through the rest of this 10 o'clock hour. And I want you, and I really listened to this argument several times to figure out what they're really arguing about. And again, two very smart individuals with their opinions on this market. We're going to figure out which one really has the most merit, so that you can take away from today, where do you go from here? Hi, I'm Wes Moss, and thanks for taking a minute to hear about what's so different about my new book, You Can Retire Sooner Than You Think. So unlike other retirement books, this book will give you a step-by-step guide, whether you're in your 20s or 30s or 40s or 50s, to learn from what these successful and happy retirees did to get there. I hope you enjoy the book, but more importantly, I know that it'll help you retire sooner than you think.